Imagine you are carrying credit card debt that grows a little every month because of high interest. Then you hear about a card that promises low or even zero interest for a while if you move that debt over. It sounds like a rescue rope. And sometimes it truly is. But a balance transfer card can also become a quiet trap. The difference is in how you use it. A balance transfer card is a credit card that lets you move existing debt from one or more cards onto it, usually to take advantage of a lower introductory interest rate. The promise is simple. For a limited promotional period, you pay little or no interest on the transferred balance. That breathing room can help you focus on actually reducing the debt, instead of just feeding the interest. Why do banks offer this? Because they are competing for customers and betting on behavior. They hope you transfer your balance, then either carry some debt past the promotional period, miss a rule, or keep the card and use it for new spending. The introductory offer is real, but it is also a marketing tool. Understanding both sides keeps you in control of the deal. Here is the first hidden detail: the balance transfer fee. Most balance transfer offers charge a fee, often a percentage of the amount you move. So transferring a large balance is not free. Before celebrating a zero interest offer, you have to subtract this upfront fee. The math still often works in your favor, but only if you actually calculate it instead of assuming the offer is pure savings. The second hidden detail is the promotional period. The low or zero rate lasts only for a set window of months. After that window ends, the regular interest rate kicks in on whatever balance remains. This is the make or break factor. A balance transfer card rewards people who use the window to attack the debt, and punishes people who simply relax and wait. Let us walk through a healthy example. Imagine someone has debt on a high-interest card. They open a balance transfer card with a long zero interest window. They pay the transfer fee. Then they divide their remaining balance into equal monthly payments designed to clear it before the promotional period ends. They do not add new purchases. By the deadline, the debt is gone, and they saved real money on interest. Now the unhealthy example. Someone transfers their debt, feels relieved, and treats the low rate as permission to relax. They make only minimum payments. They also start using the old, now empty card for new spending. The promotional period ends with most of the debt still there. The normal rate begins. Now they have debt on 2 cards instead of 1. The rescue rope became a longer fall. This is the core danger of balance transfers. They do not erase debt. They relocate it and pause part of the cost. The debt is still yours. If a balance transfer is not paired with a real payoff plan and disciplined spending, it often just delays the problem and sometimes makes it bigger. The tool is only as good as the behavior attached to it. There is also a subtle trap with new purchases. On many balance transfer cards, the special low rate applies only to the transferred balance, not to new spending. New purchases may collect interest at the regular rate, and payment rules can be complex about which balance gets paid first. The safest mindset is simple. A balance transfer card is for paying off debt, not for new shopping. Another rule to respect is the payment discipline. On many promotional cards, a single missed or late payment can cause you to lose the promotional rate entirely. Suddenly the normal rate applies, and the whole strategy collapses. So if you use a balance transfer card, automating at least the minimum payment, and ideally your planned payment, is not optional. It is protection for the entire plan. Let us talk about who benefits most from a balance transfer card. People with a clear, fixed amount of debt, a stable income, and the discipline to stop adding new charges. For them, the promotional window is a genuine gift. It turns months of interest payments into months of real progress. The strategy fits people who already want to change, and just need cheaper room to do it. And who should be cautious? People whose debt keeps growing because of overspending, not just bad luck. For them, a balance transfer can feel like a fresh, empty credit limit, which tempts more spending. If the underlying habit is not addressed, the balance transfer becomes one more chapter in a longer debt story. The card cannot fix a spending pattern by itself. There is also a credit score angle. Opening a new card can cause a small, temporary dip from the credit check in the new account. But moving debt to a new card can also lower your utilization on the old cards, which may help over time. The net effect depends on the full picture. The key point is that the score impact is usually minor compared to the interest savings. A common mistake is closing the old card immediately after the transfer. Closing a card can reduce your total available credit and shorten your average account age, which may slightly affect your score. Often the better move is to keep the old card open but unused, or used very lightly and paid in full. The decision depends on fees and temptation, so think it through calmly. Before transferring, run the simple math. Estimate the transfer fee. Estimate how many months the promotional period gives you. Divide your debt by those months to see the monthly payment needed to finish on time. If that payment fits your budget, the strategy is realistic. If it does not, a balance transfer alone will not save you, and you may need a broader plan. It also helps to read the fine print on a few specific points. The length of the promotional period, the balance transfer fee percentage, whether there is a deadline to make the transfer after opening the card, the regular rate that applies afterward, what happens if a payment is late. These details decide whether the offer is a genuine tool or a polished trap. Used well, a balance transfer card is one of the cleaner tools in debt payoff. It does not promise wealth and it does not erase what you owe. It simply lowers the cost of borrowing for a defined window so your payments do more work. Paired with a payoff plan and a pause on new spending, it can shorten a long debt journey significantly. So here is the short version. A balance transfer card moves existing debt to a card with a low or zero introductory rate, for a limited time, usually with an upfront fee. It is a powerful tool for disciplined payoff and a quiet trap for relaxed spending. Do the math, avoid new purchases, automate payments, and finish before the window closes. The card helps. The plan saves you.